Coming into this November jobs data, there was some concern that the largely positive story we've seen for all of 2015 might be interrupted by a negative chapter. But in fact, we see more than 200,000 jobs added for the month of November, a little better than the trend throughout the earlier part of the year. And we saw upward revisions in the previous 2 months. So the pace of hiring, not off to the races per se, but respectable. And that does seem to indicate that the Federal Reserve can now begin to think about raising interest rates more seriously, just a matter of days away. There are a number of ways to look at the impact of the Federal Reserve's decision to raise interest rates, and while we are reminded of the fact that we expect that to be very modest, there are some things that are affected more than others in the financial product spectrum. So at the top of that list is adjustable rate mortgages and credit card rates. Within a couple of months, we can expect people to see a direct impact on that. In terms of the financial markets, this has been the most predicted event in the history of the universe, it seems, in the sense of the Fed beginning to raise interest rates. So it really should not surprise anyone when the Fed does this. But it's also fair to say that there are likely to be unintended consequences of the Fed move. For among other reasons, there's a real disconnect right now between the global economy and the U.S. economy. European central bankers are trying to add accommodation while the Fed begins to take it away. And, that can cause unexpected things to happen, and I think we'll be standing around at the end of 2016 saying that may not have turned out exactly as we expected, but having said that, we do believe, based on what we know right now, the U.S. economy can absorb this just fine. Janet Yellen is seen, first of all, as a highly respected central banker. She has a lot of help in the sense of staff and other minds on the Federal Open Market Committee. What she really wants to do right now is do no harm, to the extent of the Fed wants to get away from this crisis level of interest rates, again 0 to 1/4% on the federal funds rate, and allow, for example, the long-term unemployed to find work, allow working Americans to have a better pace of wage increases. If indeed the Fed can allow the economy to continue to return to normal, I think the Fed will be saying job accomplished.